There's Jan Hatzius. He says inflation moderating. You warned me yesterday of a mild market move in inflation, a mild stagflation environment. Set the scope for mild stagflation, Nouriel. Good morning.
Well, there is a series of severe supply bottlenecks in goods markets, in labor markets, in energy markets, in semiconductors, in commodities. And that has led to a significant increase both in core and in headline inflation. At the same time, that has led also to a slowdown in economic growth, driven both by a weakness in sentiment, consumption is slowing down, and the supply bottlenecks also reducing growth. So mild stagflation means we have a significant slowdown of growth, and we have a meaningful increase in headline and core inflation. That's the situation. In my view, is going to be persisting, not just a one-quarter phenomenon, but persisting for several quarters.
Persisting at what level, Nouriel? Just give me an idea of whether you're talking about, what, 5% on the headline, 3% on the core? What's your definition of persistent?
Well, as you pointed out, Goldman Sachs, like most sell-side research, like the Fed and others, expect that core PCE inflation that by year-end will be probably above 4% is going to go down to 2% by the end of next year. That is the target. I see the remaining above 3% next year. And therefore, it will be a very difficult situation for central banks because you'll have slower growth, you have inflation well above target, and much more than they expect it to be. And therefore, if they care about growth, they should hold on raising rates. But if they care about inflation, they should be tightening sooner and faster. So it becomes a very tough dilemma for central banks.
It's going to be a tough dilemma. So at 3% on the core, let's say 5% on the headline, Nouriel, what does that do to the bond market? Does it take me above 2%? What's your outlook for treasuries? I asked you yesterday, could we face something like 1994 where the bond market moved by 200 basis points? A different set of circumstances, I grant you. But what is my risk in yield spike in the bond market in the scenario you've just painted?
Well, it depends on the reaction function of the Fed. If the Fed is behind the curve when inflation is still well above target, inflation expectations are going to rise. Nominal bond yields are going to go higher, even if real yields may not go higher. If instead the Fed is tough and it has to raise rates faster and sooner to fight that inflation, then real rates will rise and bond yields will rise as well. But even in a scenario in which the Fed and other central banks are dovish and behind the curve, if inflation becomes higher and volatile, inflation risk premium are going to go higher and bond yields can go higher.
So let's just get some views from you on that and the consequences of that. First of all, if inflation is persistent over several quarters, do equity markets, because you say the 60-40 portfolio, it's almost like a toxic double shop. Equity should go down, my yield should rise, so I'm going to lose on my bonds and lose on my equities. Give me some quantum of how big an equity shock I could get in 2022. Let's start there.
Well, I'll give you an example. In September of this year, you had a mild increase in bond yields in the U.S. 10-year Treasury yields went up, I think, by 22 basis points. The S&P 500 corrected by 5%. This is a typical example where bond prices and equity prices become positively correlated. They're usually negatively correlated when inflation is low. But when you have an inflation shock or a Fed shock, then the correlation becomes positive and you lose on the bond side of your portfolio and on the equity. So 22 basis points increase in 10-year Treasury yields has led to a 5% correction in the stock market. The other point to make is that now many parts of the U.S. stock market, S&P 500, are long duration assets because it's heavily weighted towards growth and tech stocks. And those types of growth and tech stocks that are long duration are much more sensitive to increases in long-term interest rates. So they correct even more than traditional stocks when interest rates rise.
So I've got to get out of long duration, but then what do I buy as a natural hedge to that? How do I hedge myself for this scenario?
Well, in a scenario in which inflation is going to be higher over time, you want to be away, of course, from long duration bonds on the fixed income part of your 60-40. I would say you go to short duration bonds that reprice as inflation becomes higher. You go to TIPS or other inflation index bonds. You go to commodities, including gold, precious metals, but probably also oil and other ones. And there are some forms of real estate assets that might be also a good hedge against inflation. High quality infrastructure investment and stuff that is in limited fixed supply.
I kicked off today's show with oil raging higher. Gas prices are lit up, as we both know. Coal is up 70%. Nouriel, let's deal with the oil market. You're here in the UAE. We're close to Saudi Arabia. I know you're talking to lots of different people. What is the risk, Nouriel, that we break $100? My last guest said, no, there's plenty of supply from the US, from Saudi, from Libya, etc. will come on board. You disagree?
Well, in part, it depends, of course, on what OPEC Plus is going to do. Secondly, it depends on whether the US and Iran reach a deal on the nuclear issue, in which case there may be supply coming as well from Iran. But I see a situation in which fundamentally for the next few years, the supply of fossil fuels is going to be in relative fall because we are decarbonizing or trying to decarbonizing. Financing of coal, of natural gas, of oil is not feasible. And the shareholders of big oil are also saying, underinvest. And if you underinvest today, you're going to have much less new supply in the future, while the supply of green energy is not going up fast enough. So you'll have, in relative terms, demand growing because there's growth in the global economy, but the supply of energy is going to be limited. That's why I see an upward trend in oil, coal, natural gas, and other energy prices. And about oil being above 100, it depends also on the hoarding behavior. If around the world right now there is a scarcity or perception of scarcity, everybody may be trying to hoard oil, natural gas, or coal in ways that then push the price much higher than the current level as well.
Okay, so you do see a risk. You do see a risk of oil above $100. In what time frame? Briefly.
Yeah. Well, you know, in the next few months, I would say that certainly is a significant risk. Of course, depends also on how cold the weather is going to be in Europe, in the Northern Hemisphere, and other variables. But that's a material risk at this point, yes.